Well, the big question on the markets today was, could the ASX make it 9 consecutive days on the up? Well, it couldn't. Banks and big miners were out of favour, perhaps a bit of profit taking, as both sectors have been running quite hard. So-called defensive stocks like supermarkets and utilities did well. And the Australian dollar was already heading lower before the RBA minutes landed. It took another leg down with the confirmation the door is open to another rate cut next month. So the post-Brexit rally has ground to a halt here, just in time for the reporting season. In the US, however, they've coincided and Wall Street has been going from record high to record high. But government bonds are also rallying, and that raises big questions. Because traditionally, a rising stock market means an improving economy, while a rally in government bonds means a worsening one. So which one to believe and why? Well, for his take, I'm joined in the studio by fund manager Roger Montgomery. Now, Roger, traditionally, as we say, we've got a rising stock market and rising bond prices. How can that be?
Well, the rising stock market is a function of declining bond yields, which is obviously the corollary to the rising bond prices.
Yes.
What's happened is the bond market is no longer sending appropriate pricing signals to stock market investors. And so investors are being lured into buying stocks because their yields are relatively higher than what you can get in the bond market. But unfortunately, it's not being supported by growth. So in aggregate, I'm talking in aggregate now, but companies can't grow through borrowing because they're already geared to the eyeball, so to speak. They can't grow through retained earnings because in Australia, for example, the payout ratio has increased between 2010 and today. It's increased from about 55% to 85%. In the United States, the same ratio has gone from about 35% to 55%. In other words, there's less money companies are retaining in order to grow. So they're not borrowing because they've got too much. They can't borrow anymore, so that credit-fueled growth doesn't exist. They're not retaining profits to be able to grow, and the bulk of the borrowings have been used for financial engineering. So companies have used the borrowings in aggregate to buy back stock, pay dividends, and for mergers and acquisitions at expensive prices. So shares are going up, not supported by growth, and the only justification for buying shares is that bond rates are declining.
But is there something more than that? I mean, there's something else muddying the water. What about the role of central banks, for example?
Indeed, so we've got something like 30% of all global bonds now showing negative yields. And if we take Italy as an example...
That is extraordinary, isn't it?
The most bizarre of all, I think, is Italy. Yeah. Italy has $400 billion of non-performing loans in their banking sector. They need a bailout. And yet the government today can borrow at lower rates than when the economy was going well. So clearly the pricing signal that we usually rely on from the bond market isn't working, and that's because governments have been buying bonds.
Yes. Now, Bill Gross, he says that $10 trillion we now have of these negative rate bonds. He says this is a supernova that will explode one day. What's the likely trigger for that explosion?
Well, look, some people say that if you keep calling, the only way to be successful forecasting is to just forecast often.
Yes.
And it will blow up at some point because, as I said, the only justification for paying higher prices for shares is subsequent increases in earnings. And for many companies, that's just not happening, particularly the large cap blue chip companies in Australia. They're not growing. As we just heard in that package, the banks aren't growing. We know Telstra hasn't grown for a decade or more. We know the iron ore companies and the oil companies are cyclical.
And is this true in the US as well? Because
absolutely.
At the moment we've got the utilities propping up this market. Is it the same in the US?
And the utilities is where you're seeing the most extreme pricing, because these are boring low growth businesses that are trading on multiples that have never been seen before. Again, only justified by record low interest rates that are being manipulated by government buying, and so a false signal is being given to market investors.
Briefly, how should investors now look at this stock market rally?
More than ever before, it's important that they only buy shares in businesses that are growing strongly, that can justify their premiums.
All right, Roger Montgomery, thank you very much for that.
It's a pleasure.